when people get into ETA, you have the opportunity to go make a huge upside case, just like those jobs, PE, IB, big law. But there's a pretty good chance that the downside case happens, or the base case, which is a modest, wealth impact. So like your expected returns are still probably lower as a small business owner.
Oh, for sure. I think definitively. Obviously, it depends on what your personal kind of career paths options are. But if you're coming from big law or PE and you're looking at it purely from a money perspective, I think the expected value is definitely lower in self-funded search. Welcome back to The Intentional Owner on our now bi-weekly cadence of recording. Is it bi-weekly or bi-monthly? What's the correct?
I am almost 40 years old, and I still have no idea what the difference is. So,
all right, we're either bi-weekly or bi-monthly or potentially both, but it is what it is.
Fancy speak for every other week.
Exactly. How's it going?
It's going great, Kaustubh. How are you?
Good. Like I was telling you, I'm going to sneak off and play a round of golf today, which will be the first time I've played golf during a weekday. Since I've owned Blue Mo, I've played a couple times, but they've been like events, right? Like I played with Lisa once when she was our lender. So that was like more of like a, businessy in a sense. And then I helped organize 2 like search events. This is the first time I'm just playing purely for fun on during the workday. So that's kind of a cool, milestone.
Yeah. I mean, it's a proxy for one, like fire drills aren't overwhelming you.
Yep.
And 2, it might be a better, more sustainable way to have fun is during the week, because I think we've talked about this before, but in my phase of life, when you have the kids and spouse, weekends end up being like sacred time. And then asking, hey, can I go have 4 hours to go play golf? Which my wife knows golf is not 4 hours. It's 4 hours from like first tee to 18 green.
Exactly. No, that's exactly right. And I think I see that, especially now that Anna and I are getting into a rhythm here. Like our weekends are pretty full. We just have things to do, right? And if we want to like buy new furniture for the place or any of that type of stuff, like that just takes the slot that golf would have taken. So I'd love to figure out how do I kind of ease it into my daily life.
Cool. And by the way, guys, it's Wednesday. So Kaustubh's playing golf in the middle of a week, which is maybe... It's not the reason people go into ETA, but the freedom, the independence, that's a tenuous topic because, there's probably a chance you're going to be working at 10 o'clock tonight and paying the price for playing golf, but at least you got to play golf.
Yeah, exactly. It's more like you get to pick where the work goes. And, it's a nice day, so I want to go outside during the day.
Great idea. Shall we hit quickly on our activity competition for anybody tracking?
Yeah, I think so. Johnny, is going to put the actual link now in the next recording. He asked me for the link, so now people can actually see how we're doing if they care.
Oh boy!
And how we're doing is that Sam has crushed me 3 weeks in a row, but I'm chipping away at getting closer to a win.
Yeah, but to be clear, you won the first week that counted.
Well, yeah. So I won the first week, and then you've won the last 3 weeks. So you're off to you're winning 6-3, given how we've come up with the scoring system.
Kaustubh and I were talking earlier before we clicked record that sometimes it's I don't have an ability to go like very consistent. I can go really hard or not at all, and so you're just catching the really hard side of the knife the last few weeks. Let's see how we're doing it once we get to July and August, and it's
totally
400 degrees here in Florida in my garage and 65 in Seattle.
But somehow you're doing, 2 weeks ago you did 7 active days out of 7, and 6 of them you did 10,000 steps. That's impressive. That's just really good. That's hard to do that many days.
It's not, because I have 2 things that cause me to get a bunch of steps. One, I go for a walk with the kids most nights after work, a couple miles. And then I try to take a phone call or 2. I think I just forgot kind of to do the points on the 45-minute walking calls. Like I'll do a bunch of 20-minute walking calls.
Yeah.
So I don't often hit the 45-minute, but I do get the steps for it. So
Nice. Okay, that makes sense. Smart. Yeah. Okay. I am finding it definitely motivating because I'll check the sheet throughout the week and see how you're doing. And it kind of gets me up and moving.
And then I have the opposite fear, which is like come Sunday, I kind of know once I've input my stuff where things stand. And then I go to bed knowing you still have like the time change difference to just blow me out.
That's true. That is true. But it's the worst time, right? The Sunday night is that really the moment I'm going to gear up and just do a huge workout. I don't know. But you're right. I could, in theory, do that.
That's right. One other thing we thought we'd mention is if you look in the corners of our screens, for those of us on video, you will notice two identical objects called Peloton bikes, one of which is collecting a lot of dust, and the other one which is getting absolutely rocked by Kaustubh. So
yeah,
if you're interested, he and I were going to actually try and do like a what do you call it, synchronous bike ride. You share usernames, you jump on the bike and kind of motivate. So anybody wants to join, DM us on Twitter. I don't know.
Yeah, with your username. That'd be kind of
Mm-hmm.
fun to have like a SMB ride.
Yeah, I actually tried that like 2 years ago with somebody on SMB Twitter, and he so absolutely destroyed me that yeah, I decided not to participate anymore.
That's all right. You just got to show up. That's what you're going for.
That's right. Well, what do you say we get into today's topic at hand?
Let's do it.
All right. So we've kind of got two things on hand. And I'm going to start with kind of a question that applies to both of us. And that is a debate. It has nothing to do with Bluma or PSG, nothing to do specifically about your industry or mine. But why would anyone do a self-funded search when your alternatives are really attractive? So for those of us who came from a sort of professional services career, if you look at your boss or your boss's boss, generally, they've kind of got one of those lifestyles that seem attractive to people in school and college. And, maybe they're making a decent income. They work in a fancy office. That was kind of the dream for a lot of us. I can speak for myself. And then it really quickly became not the dream. So yeah, maybe Kaustubh, why you? You've kind of touched on this before, but in general.
Yeah, I mean, I think in those fields like big law, PE, investment banking, I think there's some like people who are entering them, they have this idea that it'll get easier over time, right? And I maybe that's the case of firms, but I never really saw that either. Like even with the lawyers we worked with, or the bankers we worked with, or the firms I was at for PE, like the senior folks who kind of really made it for longer than 10 to 20 years in those industries, like they're just grinders, right? Like they never slowed down and kind of like got to the good life, so to speak. They make even more money, obviously. They make kind of like shocking amounts of money, but you never, like, it's not like there's a destination that they arrive at which point, like, now they have full control of their time or their life.
So I noticed almost the exact same thing. Many of the partners at our law firm, especially the senior partners who were either at the top of their like technical craft or the best rainmakers, they were working so hard that in many cases their family life was kind of in disarray. I would regularly see them in the office, on email, at all hours of the day. I don't know what they were making. I mean, millions of dollars a year in compensation. And to your point, it almost didn't ever look like any partner could trade down some of the money to trade back for some lifestyle.
Correct.
It was full throttle or nothing and nothing in between.
Well, I remember, so when I was working at Bain, one of the senior partners at Bain Capital, he went on some interview, like Bloomberg or CNBC or whatever, and he said something like, "Oh yeah, like this is the what is it?" He said, "This is the NFL of capitalism." which
That's awesome.
all of the analysts and associates were like, oh,
Oh
that's
boy.
so cringy.
Oh
God.
boy.
Yeah. So
Please
super
nobody
cringy
record
comment.
this.
Yeah, exactly. No, it was recorded and published, which is how we all saw it. So setting that aside, like regardless of how bizarre of a statement that is, he does believe it, right? Like that's the key thing, right? So like he really truly believes that like, hey, the senior partners at Bain are the equivalent of NFL players in the NFL, right? Like that is, and like what does that mean? Like nobody like believes that like NFL players are sort of taking it easy during the season, right? Like that's just and it's just an all-out dedication to the craft to be a professional athlete. Um and that is how like a lot of the folks who I've seen who really make it in PE or big law, like they think about their job that way.
And to me, the lens is work is always first. That is what they're always doing. And every other part of their life fits around their work.
Totally. Whereas, like,
All
I
right.
feel
So
like are we trying to be more like the CFL of capitalism?
is the CFL existent? Right? Like, is
I
there
don't
a
know.
thing
I
called the
assumed,
CFL?
or what's like the semi-pro league these days?
XFL, AFL,
XF. There you go.
lots
Yeah.
of FLs.
Yeah. Um,
All right. So I think that's right. There's probably a flip side to that when you flip to ETA, which is I'm not saying there's no stress in professional services, these sort of glamorous white collar jobs that we're referring to, big law, private equity, investment banking. But I don't think there's the downside anxiety. And it's interesting, right? Like there's probably a bunch of stress regarding like, you know, today's workload, a upcoming closing, and these short-term stresses related to bandwidth, like how am I possibly going to get all this work done by the deadline?
right.
But there's no feeling, or I never saw anybody in big law have to absorb risk like my house is PG'd by the SBA loan, or sorry, my house is at risk because I've PG'd the SBA loan. Or, I am singly responsible for 50 people's income and, bearing that pressure. So suffice it to say, there's definitely a trade-off. I think if you're going to get into this, either you should know how you respond to that stress level and, be comfortable with it. Or maybe you're just the type of person that sort of rolls off your shoulder. That's not me. Maybe it's you.
Yeah, I mean, it does give me sort of newfound respect for the GPs at, the firms I've worked at, or, like what do they call it at a law firm? Like the equity partners, like
Yeah.
whoever like actually owns the business and kind of runs the business. Cause like in theory, they were feeling that business owner risk, which is very different than just being a partner at the firm where like you're, responsible for revenue generation, but you're not actually the business owner, so to speak, in the same way. Because that seems like the most intense version. It's a combo of both.
I agree. But I would say, like, to the kind of anecdote about you playing golf, there is a period where there's probably that feeling of 100% always on stress, but maybe you're past it. And I know full well, like, you push pretty hard and you've got a work ethic that is hard to rival. So when you say there's probably more flexibility and balance in SMB ownership, I think, it might be understating how much there is. You can really get to a point in small business ownership where you are able to take the pedal off the gas and not necessarily have the business flatlined.
Right.
If you're doing the right things, you're building an organization or deving, and there's a world where the business continues to grow, even though your roles and responsibilities in the business are shorter. There's fewer of them.
100%. This is kind of a side point, but something I've noticed is because small business owners, they don't make a lot of money along the way, right? Like, they will at some point potentially have an exit. At some point they take distributions. But when the business is in kind of slow and like, or not slow, but like in growth mode and reinvestment mode, they're kind of taking out as much cash as they need to live their life generally. That has this impact, I think, of you don't have the same kind of lifestyle inflation that I saw some of the folks in big law or PE really have, which is, like because their cash comp is just going up each year, they're matching their lifestyle costs accordingly. And so I think there's a little bit more of a trap there in terms of like feeling trapped into like what your life budget looks like.
That's a really good point. All right, so maybe along the way as an SMB owner, and I think this is true, people see the wealth opportunity and it does exist being an SMB owner. It generally doesn't exist for a while. And so
Totally.
you don't really have that that opportunity to start spending, into your income. But if you think about it, if you were to own Bluma for just 10 years, a totally arbitrary number based on the term of an SBA loan, and Bluma is doing 3 million of EBITDA, at that point, and your industry has proven to be pretty attractive by sponsors that are consolidating. And so there's a world where it's worth a lot at that size.
Yep.
What's interesting is I know how much you own at Bluma. You're going to have a really big incentive to sell because that check could be enormous.
Totally.
And then what's funny is, so that check is life-changing. You go from like making modest to really nice income, but then life-changing wealth potential. And then if you amortize it over the 10 years that you had owned Bluma in this hypothetical, you actually were making a boatload of cash every year. You just weren't making it in cash. You were making it in paper money.
No, I think like if you are on the something of an upside case, like over 10 years, your potential total income is higher. The problem is there's just a lot more base cases and a lot more downside cases than there are in PE or big law.
And so maybe that's the point. When people get into ETA, you have the opportunity to go make a huge upside case, just like those jobs, PE, IB, big law. But there's a pretty good chance that the downside case happens, or the base case, which is a modest, wealth impact. So like your expected returns are still probably lower as a small business owner.
Oh, for sure. I think definitively. Obviously it depends on what your personal kind of career paths options are. But if you're coming from big law or PE and you're looking at it purely from a money perspective, I think the expected value is definitely lower in self-funded search.
So what I want to do though is like your big law PE IB experience was on Wall Street. There is a lot of PE that happens elsewhere. There's a lot of big law that happens elsewhere where, like, I'm just going to guess here, like your senior partners at Bain might be making $10 million a year, which is an incredible, whatever.
Yeah.
But there's a bunch of PE partners around the country that aren't making anywhere near that. And so the trade-off is not nearly as stark.
That's true.
Right?
Yeah, I think when I think of kind of in Seattle, there's obviously a ton of kind of corporate tech jobs, right? That's, I feel like the like if I threw a rock on a street in Seattle, I'll hit like a 200K product manager. You know what I mean? That type of job, I think the expected value is much more comparable or potentially higher in SMB, because you also have, I think you have higher layoff and like W-2 risk in at a big company.
That's a good point, right? I kind of made a post about this because somebody brought it up. The customer concentration when you have a job is 100%. And that is your employer at any time, for any reason or no reason, can just say, you're out. So it's pretty scary. Anyway, I think we just wanted to cover that because because at boot camp, we see a lot of people looking to come into SMB ownership. I always ask why. And most people have the right reason, which is independence of career, independence of time, sort of building a meaningful company and all of the things related to that, non-monetary. But there are a lot of people that the monetary opportunity is driving that decision. And I think it's just fair for them to know it's not everybody hits a grand slam. Not everybody has that big wealth event at the end. And so, especially if it's going to take 10 years, it's the prime of your career. So you better have other reasons why you're getting into this.
Yeah, the opportunity cost is high. If you're in your kind of early 30s to mid 40s, you can make a lot of money doing anything else.
All right. So there's this dynamic that happens that I didn't know was happening until I'd searched for a year and somebody pointed it out to me. And that is when you're a searcher and you're sort of industry agnostic, pretty much every deal you look at, you are you have no knowledge of the industry. You have no idea what's typical, the norms, the language, the players, anything. In fact, you're the dumbest person in the room when you
Yeah.
sit down with the owner and the broker. So how did you get past that? What frameworks did you use to evaluate industries? And I know that like this was your job as an analyst, so you're better than most, but so keep it simple for us. What were those frameworks or scorecards?
Yeah, to me, it always comes back to how does this business make money, right? And I think people just kind of lose sight of that sometimes. I'm sort of surprised. And like that's really the question is like literally like what happens so that this business ends up making money? And can you sort of isolate along the path from like not having money to having made money every step that happens along the way? And then that sort of gives you an idea of like, hey, where are all the key bottlenecks or choke points or risks? Like that's how you start to understand the value chain of an industry also.
So give us break that down in Blooma's case, for
Yeah.
example.
So for us, right, like we make money by providing tree services, but more specifically, what that means is we create a scope of work related to people's trees. We provide them a price for that scope of work. We have to complete the work with the crew. We have to complete it well and invoice them for it, and then we get paid. And my core cost on that side is the fleet and the people. Right. And obviously upstream of that is you have the whole lead gen side, which in some businesses like that is the core differentiation. Um, and so really you're trying to figure out like along each of those steps, like where is this business differentiating? And to figure out how you differentiate is you have to figure out what normal is, right? Like all three of our crew leaders are ISA certified arborists. Like if every company had certified arborists as their crew leaders, like that's just table stakes, right? I now know that is not the case. That is a differentiation for us, right? That allows us to charge a higher price point.
And so do you ever get into, so that's first things like unit economics, right? Or how the business makes money. Did you
Exactly.
spend a lot of time on revenue quality? Because generally speaking, we're putting a lot of leverage on acquisitions in ETA.
Yep.
Maybe not like the DSCR or the cash flow coverage on our leverage is usually pretty good because we're buying these businesses for a low purchase price.
Yep.
So even though the leverage, the debt as a percentage of purchase price is high, the cash flow is usually very sufficient to cover debt service. But generally, the sophisticated investors are thinking about how much leverage they can put on a business based on revenue quality. So how do
Right.
you think about revenue quality?
So the way, I mean, specifically with Bluma, what I did was I asked them to give me revenue by customer, just an export from QuickBooks, right? Revenue by customer with years as the columns for as far back as they could go. And so what that ended up with was like a humongous spreadsheet with like 7,000 customers that they had worked at one time or multiple times or whatever. And then all I did is I looked at this was what 2021. So I looked at 2021 revenue and I said, how many customers from 2021 were customers that we had ever served before, right? Because the problem with tree work is it's not each year, it's every couple of years, every third year, every fifth year,
Good
right?
point.
It's not. And so that was the problem I was running into with trying to figure out revenue quality. And so by doing it that way, I was able to say, okay, roughly at that time, roughly 65% of revenue in 2021 came from a client that they had previously served, right? And that to me gave me a lot of comfort around revenue quality, which is like, okay, there at least 65% is kind of repeat revenue.
That's really interesting. I'll tell you why
Yeah.
in a sec. All right. So you kind of said 2/3 of any single year's revenue is coming from a prior customer that bought at some point in time. And
Correct.
so that kind of lowers the bar for how much revenue you need to backfill in any given year in order to get to 100% or budget revenue.
Exactly.
And so what did that make you think? Like it probably didn't make you think about how much leverage you were going to put on the business. It made you think sort of like, this is a way to analyze whether the revenue quality of the business is even one I want to buy in the first place.
Because, I mean, the way I also thought about it is, okay, if I go out and grow this business, right, and I add 10% new clients this year, so I grow the business, 10%, say, like, I feel pretty good that 6% of that will stick, or like 60% of that will stick, right? So, like, of that 10% growth, 6% of the growth will hold. Well, I don't have to go refill it each year.
Yep. And so at a certain point, you'll get to a point where like the amount of revenue that should come from repeating customers will be your old 100% or more than your original 100%. Totally. And then you're stacking up or creating the snowball. So
exactly. I think we're probably there. I haven't done the math because, QuickBook files switching, it's a total nightmare to try to do it now, which is a bummer. But my guess is we're probably there.
Super interesting. So I think this framework is a really helpful one because there is not a lot of like tactical how to evaluate revenue quality. And I think the HBR guide defines it a little differently. It's like enduring profitability, but we can squabble about the difference between revenue quality and profitability. But in our business, which is probably for most people like a scarier business, remember we're B2B fence contracting. So our customers are generally all general contractors. We do some direct to property owners, but the way we would think about it is the same as you is repeat customers. So we always analyze how much of the revenue in the year being analyzed came from customers who bought each of the last 3 years.
Right.
And in our case, ironically, it was 2/3.
Really?
Yeah. Wow, when we started. Yes. Yeah. And so that gave us more comfort around like, fundamentally, we're doing a good job. We're kind of priced right for the market because customers are coming back. And so that means we're going to get a lot of good reps by just doing our job. And then we can go out there, build our new customer base, build the snowball, and same thing you're thinking through, except in a totally different context.
Correct.
B2B contracting. So,
and if like I had the PE resources I used to have when doing diligence, right? The next level I would do is I would try to set up expert calls with a bunch of the GCs, right? And call them and say, hey, like, of your spend, are you putting 100% of it with one place? Are you doing it 30%, 30%, 30%? Like, I try to understand on the customer side, what is your share of wallet? Because that also kind of helps you see, is there an inside sales opportunity as well?
Totally. And then the other one we'd still do, is a lot of work around something for us that's probably maybe different than yours. Although I just learned when we were talking beforehand that you're doing some B2B.
We're trying, but not very. I go back and forth on if I should dabble or not, because this is like the classic like residential contractor who sees a big commercial job and probably gets burnt on it. But I'm debating.
So for us, like the end markets that the business, the target, again, we're sort of buying and building. So we buy businesses. So we do this analysis for every target. So what are the end markets? So the industries that the ultimate customer is in. Because in most cases, we're getting our direct customer as a general contractor, and they are the ones repeat buying from us every year. But whether or not they have good quality revenue depends on their customers, the ultimate property owner, developer. So we're talking about things like hospitals, schools, prisons, sports complexes, you can imagine across the board, all commercial properties. And so we kind of look at the percentage of revenue attributed to each end market. And then you can kind of do some research regarding like cyclicality mostly of those end markets, or maybe like just growth profiles of those end markets. And so that kind of drives for us the revenue quality analysis.
Yeah, I mean, like famously, the new build tracked developers, they're always like the lowest quality, right? I don't know if
Yep.
you guys think that way, but that's generally what I remember how people looked at it. So like
Yeah.
Lennar or Pulte or, I forget what those other guys are, but like
Yep.
they are gonna they're gonna buy land, and then the minute the rates environment is allows for it, they're gonna go build as many houses as they can and sell them as fast as possible. And
Yep.
then the minute the economy turns, they just pull all the way back and they pause.
Totally. So you get a bunch of
Yeah.
cyclicality in those end markets. What's funny is
Yeah.
that new build, that track home build end market
Yeah.
is that they have been really consistent for us. Now the time period's been short, right? We've only been in the business for 4 years.
Right.
So it's been generally a good trend. We actually think about track home builders as commercial customers,
Mm-hmm.
which is the way it's to us, it's not resi,
Yeah.
but we also look very much at the demographic trends in our end markets by geography, because you can service a cyclical end market like home builders in Illinois, service the same end market, track home builders in Florida, and the outcomes of those two customer bases has drastically changed just because of geography.
Right.
So that's
There's an
kind of
underlying macro to each market you're in.
right. And for you, like kind of N of one,
Yeah.
you can't change the demographic or the geography you're in unless you go open a location in Salt Lake City. So,
Right. No.
but as a searcher, it's hugely important. Hugely important.
Yeah. So I mean, going back to your original thought, right, on like when talking to owners or just folks in the industry, one of the things I like to ask them all the time is, hey, like, do you have any like rules of thumb for if things are going well? Right? Like what are the things what are the key data points or kind of the gut feeling checks you have to figure out if the business is doing okay, if the industry is doing okay? Because I find that to be somewhat revealing on like, hey, what really matters here?
And are you referring more to like just an open-ended question to try and get that gut feel articulated into words, or are you trying to get to like KPIs they track even though they might not actually have a tracker, for instance?
A bit of both. I found that like early when you're learning a new industry, it has to be open ended because you don't even know where to push them.
Yeah.
But like as an example, when I bought Bluma, like I remember Martin would tell me, we went under LOI in November, and he was telling me like, yeah, like we have jobs booked through February, right? I'm like, okay, that sounds pretty good. But the key question is not, does that sound pretty good? The key question is that more or less than last year, right? Or like, what is good, right? Like
Yeah. Are
that's
you
the problem
growing
searchers fall
backlog or
into.
burning through it?
Exactly. And like I feel like this is where I sometimes see searchers, I feel like, miss the mark on diligence, where they're like, oh yeah, he's got 4 weeks of backlog, he's doing great. And it's like, okay, but last year he had 8 weeks of backlog. So what, like that's actually what matters. Um,
And she fired 3 crews in order not to be at 1 week of backlog. And so
exactly. Yeah.
good luck.
So I'm always surprised at how quickly searchers are sort of taking what owners say on face value without actually indexing it to what the norms are, the rules of thumb are. And so that's why sometimes you need to go to a different person outside the industry, or I mean, sorry, outside of the business within the industry to say, hey, like, what's the rule of thumb? And then you go back to the owner and say, hey, where are you at on this? And just compare it to the rule of thumb, right? And like that should help create some questions.
And so that's probably the good point. Like, if you're new to the industry and you don't know what the rules of thumb are, you're totally shooting blind. And
Yep.
the problem is like just conversations with sellers and brokers, you won't get those. I've seen things like is it the business reference guide used to have? Yeah. Anyway, there's a bunch of resources you can use as a searcher to understand like those key questions to ask.
Interesting.
Anyway.
Yeah, because that's and the key, like to me, like these are generally non P&L questions, right? Like these are because like people run their P&Ls in such different ways. They're not standardized at all, especially at the small business scale. So like saying like, hey, like what should gross margin be? It's like, okay, but it depends on if they put like their entire office staff above the line or below the line, right? Like it depends.
And there's absolutely no consistency. So just
Yeah,
because they're thinking about it one way doesn't make it right or wrong. They might have
totally.
just a boatload of SG&A up in COGS, and so their gross margin looks horrific, but their net margin doesn't change because of that.
I mean, look, like I'll say, like for us, I put all my personnel costs above the line, right? So there is real G&A going into our what we would call COGS. The reason being is like the vast majority of our labor is direct labor, and so it's just not worth the like mental headache right now to try to split out the SG&A or the G&A from the direct labor. At some point when we're bigger, maybe I'll start actually splitting that out. But for now, it's just not worth the work it would be, and so I put it all in one bucket, all above the line.
Yeah,
So it's going to make our gross margin look worse than it really is.
right. And really what matters to you is not like maybe how you benchmark, but how you change year over year, so long as you're consistent
Correct.
in how you track it, account for it. All right, so our second to last, or I guess our final topic, and then closing questions, it relates to my experience in the commercial fencing business. We're both acquiring other businesses, so we're buying and building, but we're also trying to push our organic growth. And to be clear, both are very powerful value creation
Hmm.
routes. And ideally, you can do both. As a small business owner, you've done both, right? You're always pushing the organic growth, but you've also acquired. So I guess maybe we'll save the acquisition playbook for another pod. I think actually people might enjoy that because
Yep.
once you get in the game, it was always surprising to me how many acquisition opportunities you get organically. No pun on words there. Like
Right. They just sort
competitors.
of come out of the woodwork. Yeah.
Yeah, like, hey, I heard you bought Bluma and I'm kind of interested in retiring. Can we
Yep.
talk about it?
Yep.
But it is very clear the most powerful way to grow or best value creation path is like pretty sustainable, profitable organic growth.
Hmm.
So open-ended question, how do you think about generating really strong organic growth?
Oh man, I feel like I do not have a good answer to this yet. I think it's one of those things where over the last few years, I feel like I've thrown tons of different things at the wall. And over time, it's kind of started to work and the flywheel has started to turn, but it's really hard for me to like look back and point at like one thing and be like, oh yeah, that was it. That was the one that really, like moved the needle on organic growth. As I think that's what makes it hard. And it just doesn't seem like there's a one size fits all here. It depends on kind of where your industry's at, where your market's at. Like there are cases where like the just ad marketing works. And then there's lots of cases where like that's not sufficient. Like that is just table stakes. Um, but I think the very, very first thing that folks need to understand about organic growth is understanding like how do they actually measure profitable organic growth, right? Like what is the customer acquisition cost you can stomach, right, on a new client? Like how often do you think they're going to come back? So what's their lifetime value? Like all of that stuff. If you can start to understand, hey, like what does good organic growth looks like, you at least have a bit of a North Star for where you're headed.
So what that means is like first stepping back and asking yourself growth or saying to yourself growth at any cost is not worth it. And
No.
I know a few of our friends, they've gotten into a business that's very, very high margin, very high gross margin. And then after they got in, they realized like incremental growth was one, expensive customer acquisition cost, and two, nowhere near the gross margin profile of the current book of business. So
Right.
like their underwriting suffered because they underwrote poor assumptions. So like
Right.
how do you go into a deal where you know nothing about the industry and you're trying to figure that out?
Right, trying to figure out in advance what the organic growth opportunity is.
Yeah.
Man, I mean, I think the underlying industry growth itself is probably the number one driver, right? If you're in a growing industry, it's that much easier because if you're not, like any growth you drive in excess of industry growth is market share gains,
Yep.
right? Um, And so that means you need to be going out and actually competing against others to win versus just holding your own market share.
It's a good point. Do you ever think about like the participants, the sophistication of the participants in an industry? Like I think we all kind of love the revenue quality of software or tech-enabled service, but I don't know if you've ever hung out with folks in that industry. They tend to be smart and aggressive and hardworking. And so it's almost like, yeah, the margins are great, but like I'd rather compete against folks who are in maybe a sleepier industry where folks are harvesting their gains and not trying to plant seeds.
I think that's definitely relevant. The one place where I see that take people, sideways is they sort of see sometimes like, hey, like this industry has a ton of like truck and a guy type, businesses like operations. And I think what they don't realize is like those types of operations are serving a different client base because they don't have any overhead. They're not offering the same kind of customer service, but there are clients who want that because they get a different price point for it.
Yep.
Like you can't actually go out compete them, right? Because you
Correct.
can never deliver the price that those clients want. And so I think that's one of the places where people they're like, oh yeah, all the competitors are like so unprofessionalized and unsophisticated. And it's like, yeah, because they're delivering at a price point you can't deliver at. And so I think I think it's like, yeah, like who are your competitors? But who are your competitors in this section of the market you actually are going to go for?
An example would be, I've seen this very recently, the one-man bands, this very small service businesses. A lot of times they won't carry proper insurances.
Totally.
Maybe their labor is not, legal, or maybe they're not paying, labor costs the way you are at Bloom or we are at PSG.
Yep.
So like they literally are going to make profit on the same amount of revenue where you would actually lose money and it's not worth you doing the work. So you can't actually look at their customers as your customers potentially.
Exactly. You're never going to win those customers.
Yep.
So I think that's partially what makes TAM a little bit smaller than people think it is when they look at organic growth potential. But I think if you can figure out, hey, like this is where we can grow profitably and go look at that competitive set and say like, hey, do I want to compete with those guys, whoever they are? And you might buy a business that's at the lower end. And so now you're going to go compete at the lower end also.
Yeah.
Like you just need to know what game are you actually in.
True. So what would you rather see if you were to did you look at Blooma's bid history or quote history versus or win rate? I guess is what I'm asking about. Did you care about their win rate? Did you know about it before you bought the business?
I had a rough idea. I don't remember how much I dug into that. But I mean, I think the point you're getting at, right, is like if the win rate's really high, it suggests you have room to push pricing, right? Yep. And the inverse. So I don't recall now. That's a good question.
Yeah. So
for PSG.
Yeah, I mean, to be clear, we're so much better at diligencing businesses now than we were at the beginning.
Of course.
I didn't even know what half this stuff meant, to be honest. But now it's much easier. So, and it's not always clear like what exactly makes a business attractive, but it certainly matters where, like most fence contractors generally are they follow the philosophy of the seller. And there are just some sellers, like they are happy to lose business, but remain the high price offering in a market. And so the vibe in the business will never be like stressful. It's never like frantic. They win only so many jobs. They make a lot of money on those jobs, and their win rate tends to be lower, or they just bid less. They see the sort of hard bid jobs and don't even submit on them. And so I think one of those assessment or KPIs or whatever ways to learn about your business is like a lot of SMBs are kind of in the bid business, even if it's not a contracting business. And so knowing win rate is important. It's a good KPI. It doesn't tell the whole story. I think you also need to know like where they sit in the competitive landscape, kind of the quality spectrum and the price spectrum among the other firms in an area. to really understand the full picture.
Yeah. One thing, I think this is for a future podcast because it's a big topic, but I'm curious to hear your thoughts on lowering price and kind of driving to more of neutral gross margins to help get to scale. This is something I've talked about with Rich Jordan a bunch, and like I still don't know exactly where I land on it. But part of the issue in small business is you buy subscale business. And so like the way to solve subscale is to get to scale. And the fastest way to get to scale is to sell, you know, anything above $1 of gross margin. And so anyways, I'm curious. I think that's probably a bigger conversation.
Yeah. It's funny because I'm not saying I have a lot of experience there, but then I think the first thing I go to is, well, there's a lot of SG&A overhead that relates to things like headcount and revenue dollars that will make your
Yes.
net margin compress on any amounts of gross margin over certain thresholds. So
Right. Yes.
it's a
No, you have to
fun-
do the math right.
yes. I'm very nervous already about that conversation.
Cool. All right. What are the, you said you had some questions for the end?
Yes, we are between you and a tea time, so let's go to this. What is the class you took in college that you are most thankful that you took based on your job today? Not the job you came from, but today's job.
Mhm.
And then while you're at it, I'll give you the reverse. Based on your job today as a small business owner, what's the class in college that you passed on that now you're like, shit, I should have taken that class?
I should have taken that. Yeah.
Yeah.
Okay. Well, while I think, do you have an answer for the first one?
Yeah. It came up in conversation recently. So,
Okay.
I am really thankful that I took accounting in college.
I was thinking that too.
And I think I didn't realize, I just thought everybody understood accounting, but it is not table stakes among, people in general, people our age, people in SMB. It needs to be. There is no way to properly run a small business if you don't understand the language of business and what your financials are telling you. It's an impossibility. So that would be the one I wish. The ones I didn't take, like I do a fair bit of public speaking now, so I had to learn that the hard way. I should have taken more of that, but I was afraid to. And then the other one, wasn't even offered. I don't know what AI stood for back when I was in school, but I think maybe a slightly different question. What would I take today? There's going to be a class in college that's like how to effectively prompt, LLMs. And that's the one I need.
That I'm sure you could take today. I'm sure that somebody's offering it.
Sure.
It's out there. Okay. No, that makes sense. I was thinking accounting also. I'm glad I took accounting. I took 2 semesters of accounting. But the other class that kind of jumped into mind was my senior spring. I took, just for fun, I took an elective that was creative writing in the English department. And I just think like writing is a big part of my life now. And it's a lot of how I communicate with, I mean, obviously you're communicating verbally with your team too, but I think just being good at structuring your thoughts, being able to think in a disciplined way, being able to sort of get to your point in a clean, like precise, language, that a lot of that, I think like even taking just one class that's works on the craft of writing, even though I'm certainly not a creative writer by any means, right? Like it just sort of, I think, formalizes a little bit this idea that like how you speak, how you write, how you communicate, there is a practice to it and it requires thought. Yeah, I don't know. That's the one that kind of came to mind.
Super cool. I think we're going to double click on that one over the summer.
Okay. Sounds good. And then the one I wish I had taken, I probably should have taken some more kind of management. I mean, I was at an undergrad business school, right? So like, but I kind of I did more finance classes and fewer kind of culture management. And maybe those stuff wouldn't have been relevant to small business anyways, who knows? But I think I have an understanding or like I'm trying to build my understanding of how to drive team culture, drive team vision, all of that.
Well, then, Kosta, that was fun. And I think maybe more tactical than most of our conversations. So,
Yeah.
If this one gets passed around and a few more eyeballs or ears than normal, I wouldn't be surprised. That was fun.
Hey, now that we're doing every other week, I think by definition, twice the people have to listen to it, right?
Yeah.
That's how that works.
That's how the math works.
Yeah.
And I think the math also works that if you shoot, what's your handicap?
It's like 22.
All right. So 22 means your average score is in the mid 90s.
Yeah.
If you shoot over 100 today, you get 0 points on the activity tracker.
Absolutely not. Absolutely not. It's all about input. It's not about output.
Fair enough.
Absolutely not.
All right, man. Have fun.
Perfect. Awesome. Yep. Alrighty. See ya.